81% of the people are worried about an oncoming recession. Hey, this is CeoTrades, where money works for you. Today, we're looking at the recession state of the world, as we have up here. This is since November of 2021. We can see that Bitcoin has dropped 48.85%. Now, is it accurate, 100% accurate? No, it's not. However, from the dates that I have entered, this is what it shows. From November 1st of 2021, it's showing that it's down 48%. I thought it was more because of the numbers I've seen, but this is what it says. And according to this, it's down 48%. According to this website, Ethereum is down 50.9% to 1900. Bitcoin is below 30,000. There are a lot of people worried about what's going to happen with Bitcoin and Ethereum and a couple of other programs. But I wanted to show you that the reality is this. This is not the first time it's happened. This is not the last time it's going to happen. You've got to learn how to take advantage of the storms as they're coming through. And this is what we're going to talk about today. Number one is what is happening right now. We're in a spot where there's a lot of worry because if inflation keeps going up and people that consume the needs of what's happening, of the markets, of what's available out there to eat and to spend keeps going down, we have a huge inconvenience. And let me explain. But before I explain, I wanted to give you the definition of a few words. Number one, recession. What is a recession? A recession is a decline in the activity of across the economy of spending. There's less spending, but then everything is scarce. There's less food. There's less people in the markets purchasing. There's less people purchasing products. Inflation. What is inflation? Inflation is a decrease of the actual purchases. Why? Because everything becomes so expensive. We're at those points right now. I'm certain you've heard of gas going up. I'm certain you've heard of scarcity in certain products. But number three is stagflation. What is stagflation? That means it's a slow economy. Everything is very expensive and people are not purchasing. Now, there is one other word that I want you to become aware of, and that is called GDP. It's actually the acronym. What does it stand for? Gross domestic product. Now, we know that the gross domestic product is the total monetary and market value that exists. Now, how does this affect people like you and me? We see it every day in gas prices, in the food we eat, in the transportation, and so on. But another part of stagflation that directly relates to GDP is higher unemployment rates and higher inflation. Now, what does inflation have to do with this all? Well, inflation, if inflation keeps going up at the rate that we're seeing right now currently, and consumers are spending less, this leads to what is known as stagflation. Stagflation, we haven't seen that since around the 1970s, according to the charts, and that is a worrisome time because it lasts longer than the average recession in general. And we're going to look at a few charts to show you the difference. Just as I notice that we have had one major drop in the last trimester of the year of the GDP. And we're going to show you that in charts so that I don't say it and you don't see what I'm saying. So let's take a look at that right now and share it. Now, this is the GDP for the last several months and the last trimester. Sorry, March 2022 was the last time that we heard about GDP, and GDP was down. You can see the previous, which was probably at the end of December, was at 6.9%, and that positive, which was very good. But then all of a sudden it fell in March to minus 1.4%, and that is worrisome. If we have another trimester in June of the same amount of negative, then we have a recession. Now, some recessions are good and some recessions are not so good. But how long do they last? How long do bear markets last in general? We're going to take a look at that in the next charts. On average, this is what recessions look like. Now, there are two types of recessions. There's recessionary bear markets, as we're looking here, and the years that they've happened. We've had at least 15 recessions, if I'm not mistaken. And some of these, you can see the declines. Some of them range from 86% all the way down to 19%. But on average, the average recession that we've had is at 39.4%. And how long do they last? On average, 390 days. Some of them less, some of them more. The last recession that we've had, or bear market, as it's known, recessionary bear market, was in 2020, February of 2020, which lasted through March of 23, which was 33 days. 33 days was the last one. And this recessionary period, we felt it because it was during COVID, when everything was shut down. But it automatically picked up. Why? Because there was money pumped into the system and people were right back on it for several months. Now, as we look at the next chart, we're going to see some different figures here in reference to recession. These are non-recessionary bear markets. And you can see here that the latest one was in 2018, September of 2018. And that one went for 3 months, 95 days. And that was at minus 19%. But on average, the non-recessionary ones on average were 26%. And they lasted on average 202 days, some obviously less, some more. The last one in 2018 was 95 days, as I said earlier. And those recessions didn't affect the market as much as the ones that were recessionary, non-recessionary. Now, these are the bear markets in general, bear markets. And you can see we've had 15 of those, I'm pretty certain as well. And you can see that the average decline was 30%. Now, what does this figure tell you and me? That when we know that on average, when there's a bear market in the S&P 500 of 30%, people start to invest. The average investor starts to take advantage. This is what we mean by buying the dip, by going in chunks as it drops. If it drops 30%, the S&P 500, you start to invest a little bit at a time. And some of the stocks have dropped much more. I don't think I have that picture here, but I will have it for tomorrow so that you can see the difference. Now, on average, how long do these bear markets last? They last 338 days, almost 11 months or so, 11 months. But the last three, you can see right here in 2020 was one, obviously the one for COVID, 33 days, in 2018, 95 days, and in 2011, 157 days. That means that on average, these lasted under 6 months. And that means that there's a good chance that this one's not going to last a long time. However, if it is a stagflation, we haven't seen that since the 1970s, which would have been right in here, 48% drop. We're seeing those numbers in Bitcoin. Obviously, we can't compare to Bitcoin right in here, in this area right here. And those can last closer to 2 years. You can see right here, 1968 to 1970, 1973 to 1974. Right here in that period was when those happened. Now, what is the break-even point? This will show you the break-even point when things started to change, 329 days later, and so on. And on average, 603 days later is when things start to change. How many days is that? It's a year and a half, if not a little bit more than a year and a half. That's when you see 1.7 years, 1.7 years, 1 year and 3 quarters. 1 year and 3 quarters, that's about a year and 9 months on average, 1.7 years. That is the time that you'll see a change in the program. But we're looking at the 1970s, and this shows you more accurate. You can see that the earlier one was 1.8 years, but the later one, and that's the one that worries us, took almost 6 years to recover. If we see those numbers again, it's worrisome. It's worrisome. And that's why we're taking a look at this as a possibility that we can go into stagflation. Now, why are we looking at a stagflationary possibility? Number one is, although prices have increased, people are still in purchasing. People are still going out there and purchasing vacations, purchasing cars, purchasing items. However, in the last several days, or actually today was posted that car sales are down. And that is starting to prove that there is a standstill on people starting to slow down on the purchases on the bigger purchases. And I mean, there's problems with the housing market as well. Prices are going up. The interest rate is going up. And guess what? People are going to start to slow down on the purchases. I've seen land prices. It's amazing how land has gone down in its value in stocks. And the reality is land is scarce. I'd say it's a great time to purchase right now because land is down at least 35%. And if I were you, just like I'm doing, I would purchase into it a little bit and hold it because land is scarce and it will increase in value. I believe land, LAND, that's what it's called. It's higher at around, I believe it was $42 a share, and it's somewhere around $25 a share. That's a great price. That's a very good price. Also, Target's numbers were down. And guess what? In the overall sector of clothing and apparel, everything went down. I saw Macy's go down, and Macy's I like, and Target is a good investment. It depends on the numbers. We will wait because at the beginning of June, I believe the next GDP will come out, and that will determine on what happens. Now, the last 3 bear markets were short, right? And the 8 out of the 15 broke even. 8 out of the 15 years broke even. I'm not going to tell you how that is, but if you look in here, you can see the numbers, meaning that the numbers weren't terrible in there, and they were under a year. So you have the last 3 were under a year, and then you have some of these that were under a year, and that you can see the number of days it lasts. But most of these break even. The crash in general, the worry is how long do they last? Well, this is it right here. Look at the number of days that they broke even. That's the average on the bottom, and then the number of days here that actual recessions last. Now, bad things happen because of recessions. Some of the recessions will last very long, but then the good is that they do come to an end and that they are worthwhile investment. This is the time to invest right now for me. I invest according to the circumstance, and I don't want to invest at the top, which is when everybody says, oh, everything is great. Everything is great. Why would you invest up there unless you're doing the opposite and betting against the top? Here, number one this is the stock performance and duration of U.S. recessions. You can see that the last one, February 2020 to April 2020, it was 2 months, right? 2 months right here. And you can see it was the S&P 500 performance was minus 23%. But you can tell here that on average, it was 10 months throughout all these recessions, and that the S&P performance was on average plus 1.7%. And on average, if we look at the 1970s one, which is where we're looking at, this is what it looks like to see the stock market recovery and duration. 11 to 16 months is what we're looking at on average. It could be more, it could be less, but on average, 11 to 16 months. And 11 is close to the average of the last 15, 10.1 months. And you can see here that out of the 15 recessions, 1, 2, 3, 4, 5, 6, 7 were in the positive, high positive, and only 1, 2, and 3 were very low negatives. Only 3 were really bad, and 3 were very low. So it's not terrible as people think they are. Now, the max drawdown during major recessions, here's what it is. The last one was 34%. You can see in 2007, 2009, which was very high, 57%. And in 1970s was 36 to 48%. So we're looking at somewhere between these right here, between the 2007 to 2009 or the 1970s. That's where we're at right now. And we don't know how bad it can get. Here's the performance of the S&P post-recession. In 1 year after the last 15, it's only twice that it's had a first year of negative percentage returns. But on average, 13 of the 15 have had positive returns. Now, what is the average return? You could see it at the bottom here, right there. It's 18%. On average, of all the years, 18% returns. In 3 years, we've had 46% returns in 3 years. In 5, we've had 120%. That means that in 5 years, on average, from the bottom of the recession, you can have close expectancy of 120%. However, if we just take out this July 1953 to 1954 returns of 503%, these numbers would change down a bit more, and it would probably be a little bit less than the 100%, or somewhere in there. We can see the numbers in here, probably 100%. So let's say that on average, taking that 1 year out, it would be somewhere around 100%. That's still fabulous. If you put in $100, you might get $100 back in investing in stocks. That's what these numbers tell me. If you want to double your bank account, why don't you invest in your knowledge account so your money market account will grow multiplied? Until tomorrow, where we'll look at another part of investments in reference to healthy investing. Take care.